Plunging oil prices led to widespread fears that Houston's apartment market was headed for a rough year in 2015. Did that storyline start to play out in the first quarter of the year? Welcome to Apartment Market Dynamics from MPF Research. I'm Jay Parsons with your Houston update. A year ago, pretty much everyone in real estate picked Houston as a top market going forward. That changed quickly as oil prices started to plunge in the second half of 2014. And going into 2015, pretty much everyone worried that Houston, and the apartment market in particular, would really struggle given the huge amount of new supply. At the same time, we saw low oil prices, obviously for a market that's very tied to the energy industry. And so some lenders even had redlined Houston altogether. Now, 3 months into 2015, oil prices remain low, about 50% below the previous peaks, and yet we aren't seeing any signs of a slowdown. Not yet, anyway. In terms of job production, the monthly numbers still look good, comparable to what we've seen in the previous years. No meaningful difference, really. Home sale volumes haven't slowed at all. In the 12 months ending in February, Houston sold more homes than it had even during the peak year in 2007. And Houston's apartment market showed no signs of slowing. In fact, it led the country in terms of apartment absorption in Q1 with 5,465 units absorbed. That was a very good result for Houston, where demand tends to be weak in Q1 periods. In fact, Q1 demand had been negative in each of the three previous years. Strong demand is coming in part from healthy lease-up velocity. We are hearing anecdotally that lease-up velocity has slowed a little bit for some of the newest units coming online, but that's largely due to the fact that a lot of these new properties are concentrated in the same areas, and there's a lot more new product competing for the same renters. Nonetheless, lease-up velocity is still healthy. Here are the totals for new supply: 4,060 units completing in Q1, 14,161 units completing in the trailing 12-month period. That's still well below the peaks we saw in 2009, but as you can see from the chart, we're going to close that gap very quickly. Just in the next 12 months, Houston is scheduled to complete more than 24,000 units, which would be the highest level in 16 years. But for now, with more demand than supply, occupancy improved 30 basis points in Q1, up to 94.1%, a very strong rate for Houston by historical measures. Year over year, occupancy was up 50 basis points. And rent growth remained strong as well. We'll show you the quarter over quarter change to capture what's happened since oil prices started to drop. And you can see that we continue to record healthy growth. Same-store rents for new leases up another 0.7% in Q1, mirroring the Q4 increase. And as a result, year-over-year rent growth is still strong at 5%. And that's a bit below the previous peak, as you could see, but still very strong by historical measures and still slightly above the average that we've seen the past few years here. Additionally, looking at actual rent roll data from properties utilizing RealPage products, we continue to see strong renewal retention rates and strong renewal rent growth. So, impressive results for Houston in Q1, but does this change the outlook? Our baseline view is that the slowdown is still coming. It's just going to take a little bit of time to materialize. The primary concern here is the pace of construction at the same time when job growth is expected to slow. Supply is going to be reaching 16-year highs at the same time when job growth is expected to be half of what it was in 2014. Most economists are expecting Houston to gain around 50 to 60,000 jobs. Still a healthy number, so we don't think the outlook is dramatically going to be deteriorating, but certainly we don't think Houston could sustain the strong numbers that it's seen to date. And so we're expecting occupancy to drop off about 100 basis points over the next year, to right around 93%, and we expect to see rent growth to dip below 3% or right around that mark. And that's going to wrap us up for Houston. So until next time, for Apartment Market Dynamics and MPF Research, I'm Jay Parsons. Thank you for watching.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.